All right, for a reader on the broader economic outlook, Clifford Bennett joining us from ACY Securities. Clifford, good morning to you. Now, you're looking at the current situation as being quite perilous. Tell us
just a little,
why.
just a little bit, just a little bit. It feels a little bit like the last scene of The Big Short, the movie, Andrew. If you remember, there were two speakers came on the stage. One went, "It's a buying opportunity. It doesn't matter what happens, it's a buying opportunity. It's cheaper, buy more." Next person gets on the stage and says, "Boom." Of course, it's not quite that dramatic, but it is very interesting because in the last 2 days in the Australian stock market, we've given up 2 to 3 months worth of rally in just a couple of days. That can't be ignored. And also the factors behind it can't be ignored. We are losing market share in iron ore to China as Brazil comes back online. Iron ore prices collapsed. It's halved in value. And iron ore was a veil on what was happening in the Australian economy. And in the chart there, you can see this tremendous fall of last 2 days. And is that a buying opportunity or is that a big red flag warning? I know that markets are going to try and bounce a little bit today because there's going to be a lot of that idea that this is exactly that, a bargain, and who knows, it could turn out to be so. We never really know. We're always just making our best call. But I think that's a bit of a signal to be cautious. And of course, at ACY and myself personally, I've been warning for some time that exactly this event would happen. I've had a very steady theme of sell Australia, sell the Australian dollar. We did that together, Andrew, you and I on your show at 77.45 when I said that the Aussie was going to 70 cents. So well done to the show for that episode. And sell Australian stocks. And they've been heavy for a couple of months now. And they're still heavy. So
Yep.
I think we need to be mindful that something is happening in the big picture. It's being accelerated by what's happening in a downturn in US stocks and European stocks. It's a global phenomenon. In Australia, we're not going to have a sharp rebound out of opening up. We're going to have a modest, small bounce in the data. We don't have the stimulus measures we had last time. Everyone's bought all those TVs. Everyone's done all those renovations. It isn't going to be the boom it was last time. I don't know why people think that. It will be a rebound to some kind of new normal, but it will be below trend economic growth as things settle down. And our exports, iron ore, as I was saying, used to have a sort of a mask over what was really going on in the Australian economy. And we all look at the aggregate GDP data and say, isn't that good? But
Yep.
a lot of that was our exports, and they're going to moderate.
But Clifford, okay, let's take a look at iron ore. It was expected that it was going to come off, perhaps not as fast as it's happened though, which has been precipitous, granted. However, no surprise, given some sort of slowdown we're seeing in China, particularly the curbs it's putting on steel production at the moment. And more broadly, I guess, when you look at equities, a lot of market commentators actively encouraging a market correction, say it would be healthy even if we came off some 10%. So, and then I guess because they're looking for a buying opportunity, but are you saying it's more deep-seated than that? I mean, what are those other fundamentals you're looking at that's saying, well, this is actually going to set in?
Okay, so you're quite right. I mean, the US market needed a correction. What we're seeing in Australia is, if you like, a price action correction at the same time that our economy is going to really struggle. I still think we're in a recession, negative growth Q3, Q4. We were the first to forecast that, and I thought it would be Q3, Q4, possibly stretch into Q1. And that's a risk people need to take on board. And if it's happening in an environment of globally weak equity environment, then you have to worry about our local market. And there's no doubt that everyone was enthusiastic. And you're quite right, Andrew. There were expectations that iron ore had gone too far, but it's halved in value, and that Brazil is coming back online, and that we've done everything we can to upset China. And there's two-way on that, of course. But nevertheless, they are our biggest trading market, and we're losing some market share there, no doubt, to other competitors around the world. So our exports are going to be reduced going forward. And those export numbers masked our domestic economic performance, which was below trend before we went into COVID. We didn't have a strong economy going into COVID. It was below trend then. And I think, you know, with all the stimulus gone, just very quickly, because I know we're running out of time. But in the US, they spent 30% of annual GDP in terms of their stimulus input to their economy, and they've only got back to where they were pre-COVID and with 5 million fewer jobs. That's not a strong economy, and yet markets have celebrated some nirvana economic prosperity going forward, partly driven by price gouging with the excuse of supply chain disruption on earnings. So that's a positive short-term for earnings, but not long-term. So I think there are real economic fundamental flaws.
All right, okay. Yet, of course, money is still very cheap. No prospect that it's going to get more expensive at this point, certainly as far as the RBA is concerned. So if you see this weakness being sustained, then where do you park your money?
Well, I'm not sure it's going to be sustained, but I do think it is. And I think people need to be active in managing their investment portfolios. And I don't think it's money necessarily going somewhere else. It's just that when everyone wants to buy a market, everyone who wants to buy a market has bought a market, it can only go down. And all those buyers have become nothing but a sea of potential sellers. And that's a point that's often missed. So there's going to be more superannuation funds every month. Some of it's going to flow into the stock market every month. But are fund managers going to be so enthusiastic? Because remember, to them, all they want to do is keep their job. Are they going to be so enthusiastic about taking undue or further risks at this point? And probably not, given the price action we're seeing. So that'll be less buying and possibly more selling in the market after a sharp fall. I expect a reasonably sharp bounce here, and the nature of that bounce will determine whether we're in a sustained downtrend period of 3 to 6 months, or whether this was an aberration and we're going straight back up, which is the pattern people have become used to. But often, once people have become used to a pattern of price behavior, that's when it stops working.
Clifford, thanks for joining us from ACY Securities.